To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
So let's have a look at this question. On 1st of January, the issued capital of Pillbox was 12 million preference shares of $1 each and 10 million ordinary shares of $1 each. Assume that they were appropriate that the income tax rate is 30%. The earnings for the year ended 31st December were 5.95 million. Calculate EPS for A to D and DEPS for E and F separately in respect of the year ended 31st December for each of the following circumstances on the basis that. So they have given A, B, C, D, E, F. So considering all these circumstances, we have to calculate the basic EPS and diluted EPS for E and F. Okay. So this will be a comprehensive question where we will be taking care of all the scenarios possible. First important point is the earnings. Earnings is how much? 595, 0, 1, 2, 3. 595, 4 zeros, right? And number of ordinary shares is how much? The number of ordinary shares is 10 million. 1, 2, 3. Okay. So number of ordinary shares is 10 million. Earnings is 5.95 million. So in each of the scenario, we have to calculate what are the earnings per share. Now, here when they say the earnings for the year ended 31st December were 5.95, okay, that is what we need to take as the starting point. Now, one thing we know, we have to reduce the preference dividend, but then they have not given us the information about preference dividend. They have not mentioned what is the percentage. Okay, so we cannot do anything. We'll assume that this is the earnings after giving effect of tax and preference dividend, right? So first is, what is the basic EPS? Basic EPS is earnings divided by weighted average number of ordinary shares, right? So earnings is 595 divided by number of ordinary shares multiplied by 100. When you do, you get 59.5 cents per share. So this is the basic EPS, the first part. Then the second part, the company made a bonus issue on 1st of October of 1 ordinary share for every 4 shares in issue at 30th of September. So now when a new bonus issue is made, how do we give the impact of that? We assume that it has been issued at the earliest period reported or at the beginning of the earliest period reported, and for the current period also it was in effect from the beginning of the period, right? So when it is there from the beginning of the period, how do we do it? Bonus issue 1:4. When we have 1:4 as the bonus issue, what it means is 1 for 4 shares. So if you have 4 shares, you will get 1 share. If you have 1 million shares, it will be 1 million divided by 4, 250,000, right? Oh, sorry, 10 million, and this will be 2.5 million. So total number of shares is 10 million plus 2.5 million. You have 12.5 million. So EPS would be, again, earnings, this divided by 1.25, 0.476 multiplied by 100, you get 47.6 cents per share. Now the alternate way to do this is EPS is equal to EPS. The alternate way to do this is take the EPS as per, the first one, basic EPS, multiplied by the bonus fraction, right? Now what is this bonus fraction? Bonus fraction is basically how many number of shares you had earlier and how many number of shares it get added, and what is the total shares after that addition. So for 59.5 multiplied by, originally you had 4 shares, now you will have 5 shares. So earnings available for 4 shares will now be divided amongst 5 shares. So you will get 47.6. So that is also the another way to do that particular calculation, right? Then The company issued, see each of these cases are separate, okay. The company issued 1 share for every 10 on August at full market value of $4. If they have issued shares at full market value, then there is no bonus component. If there is no bonus component, you just need to take the weighted average number of shares outstanding and calculate the EPS. So in case of point number C, you will take date, number of shares, month, weighted average number of ordinary shares, right. So opening balance 10 million. And when is the issue happening? The issue happened on 1st of August. So opening balance from 1st of January till 31st of July, 7 months. So this is outstanding for 7 months. So 7 out of 12 is the weight, that is 1 million multiplied by 7 divided by 12. And how many shares were issued? 1 for every 10. So this divided by 10, 1 million shares were issued. This is outstanding, this is issued. So total or cumulative shares is this plus this, which is 11 million. This is outstanding for 5 months. So 5 divided by 12, this multiplied by 5 divided by 12, you get 458333. So the total weighted average number of shares is 1041666.67, right. So what is the EPS? Earnings, again this number divided by number of shares multiplied by 100, you get 57.12, that is 57.1 cents per share. Then the fourth one, the most interesting one, which is the rights issue, right. When it comes to rights issue, we have to calculate the theoretical X rights price and also calculate the right adjustment factor, right. The company made a rights issue of $1 ordinary shares on 1st of October in the proportion of 1 of every 3 shares held at a price of $3. The middle market price of shares on the last day of the quotation cum rights was $4. So cum rights price or the market price before the rights is 4, after the rights it has become 3. So issue price is 3. So we need to calculate theoretical X rights price. Theoretical X rights price, as I told you, take the number of shares required for 1 share multiplied by current market price, which is cum rights, plus 1 multiplied by issue price divided by n plus 1, right. So here it is what? 1 for every 3. So 3 multiplied by price is 4 plus 1 multiplied by 3 divided by 4. So that is 15 divided by 4, you get 3.75. Another way to do it is existing 3, price 4, value 12, then rights you will get 1 share at a price of 3, so which is 3, the total of this is 15, the total of this is 4, so the average price becomes 15 divided by 4, which is 3.75, right. So that is what is the rights issue or theoretical X rights price. This is the theoretical X rights price. And for the calculation of earnings per share, we know for rights issue there are 2 components: shares issued at full price, shares issued without any consideration. So to identify the shares issued without consideration, we need to know what is the adjustment factor, right. That is what we need to calculate. Now here the shares have been issued on 1st of October. So this 1st of October is relevant for calculating the weighted average shares, right. Now what is the adjustment factor? Adjustment factor is your market price per share divided by TERP, which is 4 divided by 3.75, that is 1.07. Right. Now calculation of weighted average number of shares. Opening balance 10 million. Adjustment factor 1.07, or because here there is a lot of decimal involved, what you can do is actually, instead of doing this, you can do 4 divided by 3.75. This is a better way to do it. Okay, so adjustment factor is 4 divided by 3.75. This basically tells us what is the bonus component in the rights issue. Number of months till September. So from January till September, 9 months. So weighted average is 10 million multiplied by 4 divided by 3.75 multiplied by 9 divided by 12. You get 8 million. 1st of October, there is a rights issue. Right, and rights issue is 1 for 3. Right, so this is this divided by 3, 33.33. Cumulative balance is 10 million plus this. There will be no adjustment factor. Number of months 3. So weighted average is 333 multiplied by 3 divided by 12. You get 333. And if you sum this up, you get the weighted average, right? So EPS here will be earnings again divided by 1113. So you get 0.525 multiplied by 100. You get 52.5 cents per share. Any doubt in this? So as far as exams are concerned, see, basic is simple to calculate. When it comes to rights issue, again, follow the step-by-step process. What is the theoretical ex-rights price? Then what is the adjustment factor? Then take the number of shares, adjustment factor, number of months outstanding, weighted average. So if you follow this flow, it will be easy for you to calculate, right? Now,
one thing, when there is rights issue, we have to remember that there should be a theoretical. And
you have to remember that
there is an adjustment factor, and we have to
there
adjust.
Calculate theoretical ex-rights price. You have to calculate the adjustment factor. Adjustment factor is only on the opening part, the bonus component only. And after the issue, take the number of shares and multiply it with the balance number of months.
Balance, yes.
Because see, in the opening balance, I have already given impact of bonus for that period. From here onwards, these are the total number of shares we have for the balance period of time.
Yes, sir.
Okay, right. Then number E, the company made no new issue of shares during the year ended 31st of December, but on that date, it had an issue to 2.6 million 10% convertible bonds. These bonds will be convertible into ordinary shares as follows. In year 6, 90, year 7, 85, 80, and 75. Basically, for every $100, you will get these many number of shares. Now, which period are we at? We are at 31st of December of, I think, year 1. They have not mentioned the specific date. Now, when you have a series of conversions, what is the worst case scenario for the company? 90 shares. So, you will take 90 shares for the purpose of diluted earnings per share. Okay. Now, here, how do we calculate? Let's see that. Earnings as per above 595,123,406. 595,4 that is the earnings as given. Now, to this earnings, for purpose of diluted earnings per share, we need to adjust the interest which will be saved. So add interest savings net of tax. Now, how much interest will be saved? The question says 2.6 million. So 2.6 million multiplied by 10% multiplied by 1 minus 30% the tax rate, which is 182,000. Okay, that is the amount that you will be saving because of conversion, right? So adjusted earnings is 595 plus 182, which is 6132,000. Number of shares existing 10 million. Number of shares potential. Potential means how many shares would come up if the the loan is converted. How many would come up? For $100 bond, you will get 90. So for 2.6 million, how many would be issued? So basically 2.6 million divided by 100 multiplied by 90, 234,000. So this plus this is the total shares. So diluted EPS is 6132 divided by 1234 multiplied by 100. It is 49.69 or 49.7 cents per share. So basically what are we doing? How much will the earnings increase? How much will the number of shares increase? And then we are calculating the diluted earnings per share. And the last one, the company made no issue of shares during the year ended 31st December, but on that date, there were outstanding options to purchase 74,000 ordinary $1 shares at 2.5 per share. Share price during the year was $4. Now here, what is this? This is an option. Options are dilutive. We have to calculate how many shares would be issued at full price, how many shares would be issued without any consideration or the bonus element. Only the bonus element will be diluted. So for point number F, number of options 74,000. Exercise price 2.5. Fair price average 4. Shares at full consideration would be 74,000. I will collect 2.5 per share. So totally I'll collect 185. If I issue shares at 4, then I'll issue 46,250. So bonus element is 74,000 minus 46,250, which is 27,750. This is considered to be issued for free or will be issued for free, right? And this is the dilutive portion. So earnings 595, 1, 2, 3, 4. Number of shares existing plus potential dilutive, which is 10 million plus 27750. EPS diluted would be this divided by this multiplied by 100. Sorry, I think I added 10 extra. 59.33 or 34, or that is 59.3 cents. Right? So these are the 6 scenarios. These are the type of question that will be asked from earnings per share. We have covered all: basic, diluted, issue of shares, bonus issue, rights issue, options, convertible. Everything has been covered in this particular exam. Any question?
No, sir. So, but for the diluted sir, last thing we have done, why we have taken only 92, the 90, sir? That was case scenario you said, sir.
So see, in that case, conversion can be 90, 85, 80, 75. Where will we get the maximum number of new shares? Because that will be the most dilutive scenario. So we are telling the equity shareholders, boss, there are potential bonds which can be converted into equity. The more number of the shares that would be issued to the bond holders, that much would be the disadvantage for the equity shareholders, correct?
Yes, sir.
So where will we get the maximum number of shares? When we will issue 90 shares for every 100.
Yes, yes, sir.
Okay.